Hi, and welcome to our series of What Founders Need to Know by StartStack. Um, this is a series where we are unboxing the black box of startups and helping more people understand what to do, what they need to know now and in the future as they're building their companies. We are hosting this session for founders, operators. If there are important topics that you'd like to know more about, please send them our way. My name is Elizabeth McCauley, founder and CEO of StartStack. And today we're going to be talking with David Duccini. Bringing David up to stage. David is the founder and CEO of Silicon Prairie.
Hello, Elizabeth. Nice to be here. Thanks for the invite.
Yeah, thank you very much. Thank you for speaking with us. So, we'd really like to understand the ins and outs of crowdfunding. It goes by a couple of different names, and we won't, explore those right now. But it is a topic that can get people into trouble fast if you don't know some of the details of that. So, we'd like to explore this topic with you. Certainly, fundraising has not gotten easier in this environment. It feels like, pre-seed companies are expected to show up like Series A, and Series A companies and investors are coming down into the pre-seed market, and kind of things are getting squeezed from both sides. So I think people are probably looking at additional options for and exploring options for how they can be funded as a company. So we're really excited to talk with you about all this today.
Awesome. Yeah, I know it is super interesting, and I think it's part of the challenge is that we're in an era now where this is a little bit of the hangover from COVID, where we're mediating through our devices, and all the old rules around advertising, the idea that you had to have 7 plus or minus 2 impressions just to get recall, that's completely gone. Most modern marketing folks will tell you it takes about 35 impressions just to get people to remember that you exist.
Yeah, we do a lot of marketing at StartStack for early stage companies, and on average, 7 touches to get anybody's attention, and that's just the beginning of potentially a conversation or relationship. So, tell us about yourself. Like, where did you start your career, David? Tell us a little bit about your background.
I appreciate. How far back do you want to go? Like, my first job was a paper boy. Well, I started delivering newspapers in the ripe old age of I do actually joke and say that paper route was probably one of the best jobs I ever had. Like, literally, I was in 4th grade. I had a checking account. It taught me marketing, sales, delivery. Like, the papers don't deliver themselves. It taught me that sometimes people don't pay their bills, or sometimes checks will bounce. Right, a lot of hard lessons for a pretty young kid to learn. So David Duccini, founder of Silicon Prairie, collection of financial technology companies centered around helping people raise capital at scale, publicly or privately. My background really starts kind of in software engineering. I fell in love with programming when I was in 7th grade, 1980, believe it or not. And so I've been mostly a programmer most of my life. I went on, got a master's in software engineering, ran a very successful internet company, sold it all off, and then went and got an MBA because I realized I didn't understand the language of finance. And so that's where I got essentially now I got 2 sides of the brain, right? I got the technology side and I get the business side. So when I saw the Jobs Act, pass in 2012, I really kind of lit up, okay, because I understood internet, how to do internet companies, and now I had the language of finance. I realized, okay, I think now I understand how we could sort of disrupt capital formation by doing it online. And so that's really, it's really, and actually I'd become aware of crowdfunding back in the early 2000s. I actually bought a 6-pack of beer. There was a little piece of paper in the 6-pack. It says, if you like our beer, become an owner. Something we would take for granted today, but it was kind of mind blowing in early 2000, right? The grandfather of crowdfunding was an exemption called SCORE, Small Corporate Offering Registration. It still exists. People forget about it. And so I thought, okay, well, there must be a way for us to, to capitalize on this online kind of e-commerce kind of trend, but also then figure out a way to, help people raise capital to get to the next level.
Yeah, that's amazing. And I think that there'll probably be never, never an instance where that's not going to be important. Our observation is, we're just in an entrepreneurship boom right now. We will be for the foreseeable future with, job disruptions and people choosing to do other things with their time, right? People can make their own table versus, just, constantly kind of figuring out, what's the next thing. So we're seeing a lot of founders that are, would not be considered traditional by most accelerators, founders that are, very successful or older than 40.
Oh yeah, for sure.
No, they're getting their start in a different way, and they're very experienced people. But some of these, details around fundraising and, you know, we've got a client now and working with them to help them build their financial models so they can understand the business and numbers and have a plan to follow, right? So all this becomes, critically important to running and operating a business, that stays in business actually. So you talked about being a paper boy. What was your favorite job in college?
Uh, so believe it or not, I was a roller DJ at a roller skating rink in southern Minnesota here. So yes, I've some pretty sweet moves. My partner Jade can attest that she's seen me as a much older adult on roller skates, and I still got it. So
Nice. So it's like roller derby's a thing, right? You can like
well,
beat
roller
people
derby
up
is the thing.
and
This was basically like the era of kind of like coming off the disco from the 70s
yeah.
and 80s.
Yeah,
Like the
yeah,
skating
yeah.
rink actually had like it had like the zodiac signs painted on the floor in black light, whatever. And we'd light them up wherever I turned the light on. It had the big globe, the big mirrored ball in the middle. Yeah, it was a good time.
Those are the good old days, right?
Right, exactly.
Okay, let's get into business. So
Yeah.
tell us about kind of the first we've got a couple of things that you talk about pretty often, but one of the things that you say is just build a business worth funding.
Yeah.
Tell us about that.
Yes, I appreciate that. So every business really, if you think about it, is a hypothesis, right? Which is a scientific, kind of, but if you actually follow the scientific method, you have a hypothesis and you
Mhm.
have to test that hypothesis. Now, what gets founders into trouble is when they go for broke, right? They have a hypothesis of a mythical client. It's like, well, there must be people in the world that, really need this solution. And they become very in love with their idea, but they're not really great at taking feedback, and they just don't know when to cut, when to cut and run, right? So there are three questions I always like to sort of ask, or I try to figure out when I'm talking to somebody about, okay, if they say they have a business, I need to figure out, okay, right away, is this a business or is this a hobby, right? So there's three
Mhm.
very simple questions, and you have to be able to say yes to all three. Okay, number one, are you solving a problem someone actually has? Okay, now that person can be you. You can be solving a problem that you've had. I like experiences in the world, and I want to solve this problem. Okay, cool, right? Solve a problem somebody actually has. Okay. Two, who's willing to pay you to solve that problem for them. Okay. Three, at a price point above what it costs to solve it for them, which
Yep.
sounds really trite, but that is, if you can't check all three boxes, that, Elizabeth, is a hobby. It's not a business.
Yeah. Yeah. And the other things I'll add to that is, that problem to move people off of, you know, pain versus extreme pain, I need to solve this right now, or there's consequences that are real consequences forever that buyer is, that becomes really important to change behavior. Everybody wants to do something different, but nobody wants to change to do the thing that's different, and that becomes materially hard about getting people to adopt your idea and to use your product or solution, whatever that happens to be. So yeah, we agree that pressure testing ideas and moving, tapping into extreme pain to solve the problem, and then understanding that as a critical part of the methodology.
Yeah, for sure. I mean, well, ultimately, the phrase I like to use is unfair competitive advantage, or
Yeah.
solving an unmet need. So solving an unmet need might be the riches and the niches story, right? So you're solving an unmet need, or maybe you're solving in a way that other people aren't solving it. But fundamentally, all really successful businesses must have some unfair competitive advantage. Now, old school businesses used to have arbitrage. Like, hey, they could buy a product cheap and sell it at a higher price someplace else. Well, the internet has sort of decimated that. Like, we have price discovery now. Like, we can instantly figure out, okay,
Mhm.
is this a fair price for this thing or not, right? So now, in order to compete, you can't just compete on price alone. Typically, that's not a
Mhm.
very powerful position to be in, because as we've seen with like Uber, like they can just subsidize stuff to run taxis out of business, right? So you can't outwin that game. But having an unfair competitive advantage or solving an unmet need is really going to be a key differentiator to building a viable business.
Yeah, one of the things that we have observed for the last couple of years, something I've been saying very consistently, is domain expertise is a new technical knowledge. When someone knows a lot about something very specific and they're really a master of that domain and the nuances of those process problems or the problems that are very difficult to solve because they're complicated, those seem to be bubbling to the surface as very good use cases for AI native applications and those kinds of things.
Yeah, and what's really awesome is that as a subject matter expert or a knowledge worker, right? Knowledge management, knowledge transfer. Now we're in an era where discovery is really important, right? The idea that people won't know unless you tell them, right? And so the ability to have a place to be discovered, like there's lots of venues besides the old school job boards. Now there's all sorts of social media places you can demonstrate mastery on social media sites,
Mhm.
and then also by building professional networks, right? And essentially finding contemporaries, not necessarily competitors, but contemporaries who does well when you do well, can really, leverage the
Mhm.
power of the spoken word, right? The soft referral, right? The word of mouth advertising is still the most powerful form of advertising. And so by becoming and demonstrating mastery of a subject matter expertise or a domain, and then getting a following, right? That can be
Yeah.
essentially a great source of leads perpetually.
Mhm. And, your point about, being differentiated, business moats are very difficult. I think of moats in a couple ways. There's business and technical moats, and being able to master both of those at the same time seems to be, really important as companies are, you know, building solutions to solve a problem, and then also making sure that, they can differentiate on that and, ward off competition. But it is getting much harder.
Oh, it for sure is, but it's also in a lot of ways a lot of the mundane is getting a little bit easier. I mean, that's sort of the power of AI as a tool and a platform, right? Now it can turn almost anybody into a coder. I like to say, I like to practice this. I'd say, play to your strengths and outsource your weaknesses, right? Just because you
Mhm.
can do something doesn't mean you should do something. And so
Good
I
old
think that's,
fashioned
yeah, exactly, right. Well, not everybody
good old
does.
fashioned outsourcing,
Yeah,
right?
well, some people just, they're control freaks and they just, they get themselves in trouble, right? You'll have so much time, money, morale, and focus, and people will steal your focus, which can damage your morale, right?
Yeah. Yeah, that's right. So we're talking a little bit about the problem, people bringing solutions to market, and then the question that usually founders start to grapple with is, is this a business that I can do on my own? Can I self fund this? I particularly have a problem with the word bootstrap, but okay, I'm from Texas.
Mhm.
But can you be self funded, or do you need help to get this product or service to market? And there's some businesses that really are very difficult to self fund. So, talk about this question a bit around, how um, founders should work through that kind of logic. How have you seen people do that successfully?
Yeah. First of all, you said you're from Texas and you don't like bootstrapping? Is that because your boots have zippers?
No, no,
Boot
it's
zip,
just it's
boot
a
zip your business.
it, yeah. I like the word self funded because it's
Yeah.
intentional, right?
Yeah, well,
Trying to keep
it's
money at
run
the
on
end.
revenue, really, right? And this is,
Yeah, yeah.
yeah, run on revenue for sure. So, and yeah, I mean, you'll see the class even when like the word bootstrap. The best advice is to bootstrap, for as long as you possibly can to delay funding. There's one of my mentors from my time at the Carlson School, a gentleman named Dilip Rao, who's studied billion-dollar entrepreneurs, the BDEs. Um, I was sitting in class one day and we were going over corporate finance and he was going through different options, companies issue bonds or stocks, whatever. And I was like, okay, I'm pretty sure it's just not that easy, right? You just don't issue a bond, right? It seems like a highly regulated thing. And so another student asked him like, what's the best source of capital, Dr. Rao? And he says, revenue, right? Revenue is your best source of capital all day long. It
Yeah.
gives you the most optionality. Like if I was going to, if I have, we only have so much time every day. And when I wake up, okay, do I want to focus on trying to raise money? Or do I want to focus on trying to generate sales for my business? And I'm always on the generate sales for the business. Like it's always about top of funnel, right? Especially
Hmm.
since those investor conversations might be ad hoc or coincidental. Like you can't necessarily plan them. You can try and plan them, but really getting a hold of somebody's attention, right? Where they are and when they are is difficult. So I agree with you that, realistically, you should one, delay trying to take other people's money for as long as you possibly can. Two, to think about really focusing on generating revenue, which is what your angel investors are going to want to see anyway. And essentially the venture capitalists, they're going to see, okay, well, what kind of traction do you have? What kind of MRR are you doing, or ARR? Like they care about is revenue for the most part. And so, and revenue is so important in terms of in the overall sort of life cycle of a business, right? You start with a hypothesis, an
Hmm.
idea, you build a minimal valuable product, an MVP or minimal viable product. And then that magic moment when you sell it to somebody, that's when you've achieved product market fit, right? You may not have the price sensitivity figured out. Maybe it's too cheap, maybe it's too high, but somebody's willing to pay you for it, right? And that's when you've checked those boxes. You're solving a problem someone you know actually has, who's willing to pay you to solve it, and ideally at a price point of what it costs you to solve it.
Yeah. I've got a concept I call minimum viable revenue. And I agree that, revenue does solve all problems, most problems, some problems. But the minimum viable revenue number, we can set that early in the ideation of the business and know what that target is to get the business somewhat stable and show that repeatability of product market fit. That's usually a bit of magic. That's a lot of work that is easier now to design in than it ever has been. So when a founder is determining, am I fundable, and fundability looks different for different types of industries and those kinds of things. So we're speaking a little bit, general here, but what are the key questions that people should start asking about their readiness to raise?
Yeah. So the three part we have after we want to find out if it's a business or a hobby is basically it's the three-part question, like on an elevator pitch, right? Okay. Does the team have a clear need for capital? Like if I don't know why you need the money, you're going to have a hard time explaining it to other investors. Okay. Do you have an easy to understand business model explains how you do or will make money? And then most importantly, do you have some sense of obligation to pay your investors back? Right? Investors are not just, these rich, old, look mostly old white dudes, quite honestly, who are just money bars, right? So people, they care about how they're going to get their money. Like, again, if you're getting money to invest into a business, right? Your investor has an expectation of getting that money back. Like break even is the benchmark, right? Now, again, with crowdfunding, this is a little bit different sort of space because people may not be investing purely out of motivations for profits, right? They may just want to see what you're doing exist in the world, or they're a brand champion, or you walked their dog last summer and now they want to clear some social debt, right? We can talk about that later. There's lots of reasons why people might invest, in a crowdfunding kind of modality. But yeah, fundamentally, you've got to start with kind of getting out of your own head. Most investors don't care about kind of what your next level is. What they care about is the exit. They want to know, okay, well, all right, I'm going to give you some money and I'm probably going to be stuck with you for 5, 6, 7, 10, 15 years, right? What's your plan to get out? And don't just say we're maybe going to go IPO someday, right? More than likely you're going to sell off to somebody else or whatever, but you got to go into this thing thinking ahead of, okay, well, if I start this today, how do I get out in the future? And how do I make as many people as I can whole by the time I do that?
And that's part of what you talk about, telling a story about, the purpose of the business, why you need the money, what the exit plan is, like having that work through before, as part of setting your fundraising strategy.
Yeah. And that also can help inform kind of what you're selling too. Because so not every business should necessarily sell equity. Not every business is going to go public. Not every business is going to necessarily sell out. Sometimes you've got really good service-based businesses where maybe you don't sell equity because you're never going to go public, or maybe you're a restaurant that's never going to open a second location, but you want to raise some money to buy out the property next door so you can put a patio in and do 80% more covers in the summertime, right? That's a good business model. It's easy to understand.
Yeah.
And you might have some natural brand champions there who could participate in getting discounts, but also maybe sharing in the revenue for some period of time.
So talk about crowdfunding and some of the key differences. So let's maybe get into that a bit. So can you share, with the audience, maybe a bit of the history about crowdfunding and how that's evolved over time before we touch into some of the more technical details about what you need to know?
Yeah, for sure. So at the highest level, so crowdfunding, right? Got to start really with sort of the donations and rewards, like the Kickstarters of the world. That was a rewards-based crowdfunding platform where you're pre-buying a product that almost never shows up. Obviously, people know GoFundMe. That's donation-based crowdfunding. So regulation crowdfunding is the rule that came out of the Jobs Act of 2012 that was designed to allow public solicitation. And that's the key phrase here, right? Your ability to publicly solicit from people you don't know, right? So for the longest time, right, after the stock market crash, right, the Paper Act, the Exchange Act of 34, Investment Company Acts of 40, et cetera, right, private capital formation has done very privately, right? It's been these private places. You have to have these relationships, and you have to, like, if you just meet somebody, you have to go on 3 coffee dates first before you can ask to see a balance sheet, right? All that goes out the window with the passing of the Jobs Act and regulation crowdfunding. So keep in mind, right, in America, there's really like 4 ways to go public, right? Regulation crowdfunding is the baby version of that, raise up to $5 million. Regulation D, 506C, this is your accredited investor exemption, but you can publicly solicit. There's the Regulation A, the mini IPO, and then there's just the classic S1, right? So I'm on a tear to try and re-educate or help people really come to grips with the idea that crowdfunding is literally your first chance to go public, right? You're publicly soliciting for people to invest in your business. It's marketing as well as financing, but it really is, it's an amazing opportunity to raise capital in ways that we've never really had here in the States.
Mm-hmm. And while this is an option, this usually isn't something founders think about as an option for them, or maybe seems a bit risky, or some stories about how it's really difficult to get follow-on investment. So can you talk more about kind of clear the air on some of those topics that may or may not be accurate?
Oh yeah, for sure. So the classic advice that you might hear people say is like, don't blow up your cap table, right? Look out, don't have too many investors. That story actually began in the 70s and the 80s with venture capitalists bagging on angel investors, right? They were warning founders like, oh, don't take that angel money. You don't want to have like 10 people on your cap table. Just stay with us and we'll take care of you, but we're never actually going to write the check, right? So in turn, the angel investors turn around and told like, oh, don't get that crowdfunding thing. You don't want 100 people on your cap table. And so the reality is that was an issue back in the 70s and 80s when people were, had a big cap table. They had to fly around for voting events, all these horror stories. That just doesn't exist anymore, right? It's absolute myth. It's not about how many people are on your cap table. It's what the control structure looks like, right? So here's the deal. You can go raise capital right now today. You can sell equity, just sell non-voting common stock. We're trying to advise people now. It's like, well, okay, now's the time. You've never raised money before. Maybe do a class A set aside that's preferred shares, maybe for the future. Give yourself, the founders, class B common voting, and set aside class C common non-voting for your community or crowd round. And then it doesn't matter how many people you have on your cap table, right? Because there's no control issues around that. So that's one of the first sort of myths in this space, right? Now the nice thing is that since the revisions that the SEC put in place back around 2022, I think it was, is they put in the ability for founders to test the waters. So before, you couldn't necessarily say, I'm going to raise money publicly or not without actually having an exemption in place. Well, they relaxed the rules and said, okay, now you can, go ahead and publicly solicit you're thinking about raising money as long as you don't actually take any money in. And so this is a golden opportunity for potential founders to see how much money they might be able to raise before they actually commit to hiring a lawyer to put together that offering document.
Mm-hmm. That's really interesting. So just in the startup world, often attorneys want you to secure, a retainer and these kinds of things. And I've known several founders who have gone through this process, ended up paying a lot of legal bills, and actually end up with no money in the process. So is that one of the things that, is, trying to solve that problem?
100%. Yeah. Testing the waters is an awesome opportunity to, get a page up, get indications of interest, advertise, send people in, let them create accounts, let them tell you how much they might be willing to invest. And then once you have the confidence, okay, look, I'm going to raise, let's say I want to raise, $100,000, but I could put $25,000 use as soon as I had it. Well, once I've got enough indications of interest that say, okay, well, it looks like my crowd is into this thing. I've already hit $30,000 in pledges. I should go ahead and hire a lawyer and convert this thing into a real offering.
Mm-hmm. Now, is there any concern about follow-on investment? We didn't touch on that part. If people, founders, raise their initial round through this mechanism, to talk more about that.
Yeah, so it's a two-part story, right? So one that we see, especially with crowdfunding, is that communication is everything. You should communicate with your investors even when the news is bad, right? In fact, especially when the news is bad, right? Versus what we see happen time and time again is that a founder will use crowdfunding. They'll raise a bunch of money. They won't say anything to their investors, and then suddenly a couple of years later, they'll go back and try and raise more money with crowdfunding again. These people are mad because they haven't heard from them, right? So that's the first part of it. So you should absolutely, right, make sure you keep your stakeholders up to date, right? Say, like I say, here's why I would rather have 1,000 investors at $1,000 a piece than trying to find one rich old white dude to write me $1 million check, right? So one, if I take that $1 million check, I now have a boss, right, who can fire me. But the magic of having 1,000 investors at $1,000 a piece is that any one of them wants their money back because the kid needs braces. I can probably write that check, right? Not a problem. I can take them off the cap table, right? I can have a right of first refusal, buy my stock back. But here's more importantly, if I do what I say I'm going to do, I can take that $1,000 investor and turn him into another $1,000 investor, or a $2,000 investor, or a $3,000 or $5,000 investor, right? 1,000 people at $1,000 a piece is $1 million. But now I've got a passionate stakeholder base, a fan base, right? Brand champions who can help me fund in the future. So that's one piece of it. Now, the other part of it is that people say, well, if you've got all these people on your cap table, that big fancy white knight's not going to fund you. That is total BS, right? It's not about how many people are on the cap table. It's about the control structure, right? Savvy entrepreneurs can always go and form a new holding company. So raise your money now for your big idea. If you're a bright founder, you're probably going to have other ideas that might make sense in this entity. It might make sense in a related entity. At some point, you might have a couple different entities and you might need a holding company above it. Well, guess what? That holding company can have its one line on the cap table for the subsidiary. And so there's lots of ways you can sort of deal with, the follow-on financing. But I've got guys that work in our investment banking group, over 35 years of institutional investment banking experience. Not a single one of them has ever said, look, if they want to buy the company, they're going to find a way. Like, it doesn't matter, how many people you have on your cap table. Normally when these things happen, it's an asset purchase anyway, right? Or they might just use stock to buy out the founder, et cetera, or a combination of cash and stock, whatever. So there's a lot of myths in the space. Like, one, you don't have to be a Delaware C corporation. Don't spend the money. It's not your today problem. Nobody is not going to fund you because you don't have a Delaware C corporation. That's BS. So don't spend the money on a Delaware C corporation. A, it's expensive, and B, you'll pay a lot to move out of state if you want to. I recommend Wyoming or Nevada. Or even like Minnesota. Like Minnesota, you pay one-time fee, and that's free renewals, for the rest of your life, which is awesome, right? So don't worry about your Delaware C corporation. It's not gonna be your today problem. Also, don't worry about the whole, blowing up your cap table thing. I've actually seen founders struggle to get an angel to write a check, and finally, out of exasperation, they decide to launch their crowdfunding raise. Meanwhile, their friends and family and their fans are piling in, and they're filling up, whatever. And that angel investor's like, oh my God, I gotta jump in now. And so you can actually use it to tip the hat, as it were. So
drive scarcity. The Texas Stock Exchange is launching too pretty soon, so that's on the Dallas roadmap. I'm excited about that too, and I feel like we have to maybe have a reason to move back to Texas, right? So
I think they're going to take companies from other places, but
yeah, that's well, there's a little short story. We were a Texas LLC that moved into a Delaware C corp, and now it's like, well, it just makes sense to be Texas based. So yeah, that's part of our little story. So we're talking about the ins and outs of not blowing up your cap table and all the myths and things that people hear. And I've heard these things, said to me directly. Are there attorneys that really understand this space? Are there attorneys that are kind of more specialized in this,
100%.
these mechanics than others? So how would you suggest navigating, finding the right attorneys that really understand this kind of structure?
Yeah. So most of your funding platforms and broker dealers, they don't have legal staff. They're not going to draft your documents. And so we have a short list of people we think pretty highly of that have a variety of, expertise, some that are really good with real estate, some that are really good with consumer packaged goods, some that are good with food and bev. So it really kind of depends. You don't want to overpay. The nice thing is that there's a number of sort of, self-service opportunities out there for putting together your offering memorandum. So for us, the story always starts when I meet a founder that wants to raise capital. Okay, is it a business, right? Is it a hobby? Okay, let's assume it's a business, right? Let's assume that they have, the sense of obligation to pay their investors back. They got a good reason to raise some capital. Then I'll start with, okay, well, how much capital do you actually need in the next 12 months? Okay, you want to raise $1 million. Okay, well, what's the minimum amount of money you could put to use as soon as you had it? Oh, I could put $50,000 to use to get to a trade show. Okay, great. Let's focus on that $50K first, right? You want to raise up to $1 million? Great. Hope you get there. Today, we need to focus on how to crack that nut to get to 50 so that you can break escrow. Now, let's think about, do you want to publicly solicit? How much of this money is going to come from your own network? And then that will then tell us, okay, well, this makes sense to use the regulation crowdfunding offering, or maybe this makes more sense to do a private placement, or maybe because you want to raise so much money, we should, consider doing this as a, as a different exemption or as a combination potentially, right? So it's really a matter of figuring out, okay, realistically, do you want to publicly solicit from people you don't know or not? There's a couple options for that. And then after that, it's really about trying to make sure that the cost of capital is not outrageous, right? You said before, you've known people that, have paid, a lot of money. Like I'm one of them. Like when we opened up our platform in 2016, we decided to raise money for ourselves, which we could do here in Minnesota. I hired a lawyer to put together a private placement memorandum. I got a $15,000 bill. And I'm like, what is in this stupid thing? And if it costs $15,000, nobody's going to use my platform, right? So no, I
think, removing the obstacles to make the things work, we, are finding is one of the major things in the way of early stage companies. Like there's all these costs that pile up across tech and services and whatever. And it's like, if we can like remove some of these obstacles, there would be generally more participation, probably for a little bit longer. Raising responsibly is also something that, we're talking about right now, as we're having this discussion. Generally, when people have just round numbers, like how did you get to the numbers? And we encourage people to have a financial model, know exactly what the use of funds are and how the financial model ties into how they're going to build the revenue over a number of years. So do you find that people typically have financial models that drive the business and drive how they understand how much money they need and how they're going to use it? Or what's your experience with what typically people, how they approach it?
Yeah, it's really all over the map. We have dreamers like they'll calibrate based on, their competitor. Well, we should raise $40 million because so-and-so raised $40 million. Okay, stop. That's, you were never going to get $40 million, right? So stop, you can't calibrate to what other people are doing, right? You do focus on your today problems, which are like, okay, well, you've got an Amazon bill that's due, or you've got, rent to pay, or you've got, don't quit your day job until you run out of vacation, right? So really focusing on the today problem to figure out, okay, but then clearly can they practically put together, good use of funds? Like again, a lot of first-time founders think they need to raise enough money to make sure they maintain their lifestyle for the next 3 years. And guess what? People don't fund that. That's not fundable, right? And even if you did get a big check, and a lot of people don't realize this, like I've sat down with founders like, oh, congratulations, so-and-so just got a $3 million check. Well, that might've been true for about 30 seconds, right? I've literally met founders who said, yes, I got $3 million as a commitment. I got the first $1 million and I had to go back and write a check for $250,000 to the investor's marketing company and their IT company. And by the way, I have to go move into a building that this investor owns. And I'm going to pay above market rate rents. This is the stuff you don't hear about. Right?
Wow. That just makes my head hurt. That people would, that you would know about that before you accepted that money. I guess that's common.
It's incredibly common. I mean, people that are, are willing to be honest with you, they will tell you that, but it's a lot more common than you realize. A lot of people like, oh yeah, congratulations, you got the big check. And then, they get fired a month later, or they're now having these outsized expenses because again, the person writing the check, essentially, it's the golden rule. The one with the gold gets to rule.
Yeah. The one who makes the gold makes the rules. That's right. I've heard that a lot. So when we're talking about how much to raise, use of funds, there's almost a bit of a discussion people have to kind of work through in their mind is what are the strings attached with the money, and potentially with, to your point, with more people on a cap table and the crowd essentially, maybe that's a way to go about it where you maintain a little bit more control over your company. Founder autonomy is a huge deal.
A lot more. Yeah. The nice thing about the crowd, at least the regulation crowdfunding rule, is that all the communication with those investors is supposed to happen through the platform. They call it a communication channel on our system. It's a forum. And so you're supposed to train your investors to engage with you through the platform. So there's supposed to be public conversations, no side deals. And so, on our platform, if you raise money, you have access to the forum. You can actually keep that forum after you're done raising capital. Like, we're not going to turn it off. Like, we want you to keep training your investors to keep engaging that, right? Don't give out your cell phone number. You don't have to do that, right?
Seems just like
So
a logical way to stay, informed, keep your investors informed of what's going on. We hear that from um, just generally the market that founders struggle with keeping their investors informed, and it creates friction. So if there's a natural way to do that.
yeah, I mean, for sure. I mean, and our platform is designed to have, if you use our platform, you get access to a CRM system. There's a nudge email system. It looks like, a bit like MailChimp, built in. And so we're really sort of masters of communication in terms of the way that we approach, working with our clients, because our clients are the people raising money. Our clients are not their investors, right? Our clients are the people raising money. And so it's in our best interest to make sure that they are successful. They raise money, they break escrow. That's when we get paid. But then they keep coming back to us to keep raising additional rounds in the future until at some point they either go public or we help with an M&A transaction.
Are there industries that are a better fit for this type of raising in your experience, or share a little bit more about that?
Yeah, I mean, so in the early days, breweries did really well. Consumer packaged goods can kind of do well if you already have a brand following. Those tend to get funded pretty quickly. Real estate is also kind of a unicorn here. Real estate is easy to understand, right? It's easy to, okay, I can see the real estate. It's a real thing, right? I understand cash on cash
Hmm.
returns, and it's not some
Yeah.
wild valuation that's be hard to pin down, right? But realistically, it comes down to, I'd say, sentiment on the part of the founder themselves. Like I said, restaurants can raise capital. They can just do something like a revenue share agreement, right? I've done lots of service-based businesses where they're never going to go public. There's no reason to sell equity. But they can do a revenue share agreement, which is a lot more elastic than, say, just a straight note. Like if you borrow money on a note,
Hmm.
you pay it back every month, whether you have the money or not, right? Revenue share
Hmm.
agreement's a little more elastic, right? You can say, Elizabeth, if you invest in my business now in the next 30 days, I will try and return 1.7 times or 2 times your principal. And like, well, Elizabeth's like, well, that seems pretty good, like pretty good deal. Here's $100, here's $1,000, right? And then I can use a little bit of FOMO and say, hey Scott, if the clock is ticking here, like if you don't invest by the end of the month or whatever, that multiple drops down to 1.5 times revenue. So I've seen that work very well on some other platforms. And so, like I said, it really kind of depends on, okay, one, how are you going to use the money, right? What's your story to the investor to say, okay, if you give me this money, right, it's not a donation, I'm on the hook to try and pay you back. It's going to turn into more money so that I can pay you back, right? So it's really,
Hmm.
it's the use of funds is so important, which is I care about that more in the whole crowdfunding space than I care about the accounting. Like I get that, yeah, you want to have your books, reviewed or audited or whatever. I get that makes sense for certain dollar amounts or whatever, but I don't really care quite so much about what you've done historically. Like if you have a viable business, and a lot of these businesses take, 2, 3, 4, 5, 6, 7, 8, 10 years to become like viable, right? Or break even, or whatever. I care more about the use of funds, right? If the use of funds is like, well, we're going to pay salaries. Okay, well, are these salaries for salespeople? No, we're going to pay salaries for the CEO. Well, that's not investable, right?
Hmm.
I care more about
Hmm.
really how you're going to use the money and what does that mean to the business in terms of being able to generate more money, right? That's really the mindset you've got to get into when you're having a conversation with the investor, right? It's not about what your next stage is. What they care about is the last stage and when that last stage might happen.
How do y'all go about helping people onboard to your platform? And, what are some of the steps to think about? Kind of take us through the life cycle.
Yeah, for sure. Absolutely. Well, it starts with an expression of interest, right? So, you usually, like in our case, our top of the funnel starts with, either some, outreach by email or through LinkedIn or meeting at an event or following up, whatever. And then really either filling out an intake form on our side to then get you into essentially the flow, getting some helpful information to help you kind of mentally prepare for, okay, well, how much do I want to raise? And by when, and from whom am I willing to take the money? Okay, now what should I sell my investors? And what do I really have to offer that might be like a twofer or a threefer? Like what can I throw in as a sweetener to really get them to, buy into that gently used business today, right? So that's kind of
Hmm.
the overall play. And we have an entire playbook, an entire checklist. But fundamentally, it's going to require once we figure out how much money you want to raise, by when, and from whom you're willing to take the money, and then we'll present a couple of different options of, okay, well, this could do well with crowdfunding, or that's such a niche thing. What we should do is really go look and chase down industry professionals. Like maybe it's maybe
Hmm.
you've got some medical device thing that cures something or solves something, or whatever, but your average person is not going to understand it, but guess what? There's entire support groups out there that want to see this thing exist, right? So it's really a matter of kind of understanding, okay, what is it? Why is it attractive and to whom? And then really putting your marketing hat on to, I'm so used to talk about the amazing upside of my product or service. Now I need to shift the conversation around and say, okay, now I need to talk to you, Elizabeth, about the amazing upside of my business, right? And that's a totally different marketing pitch. In fact, most marketing people I talk to, because we get pitched all the time, well, we'll help you market. Okay, fine. But can you have a conversation around getting somebody to talk about the amazing upside of their business, right? Because that's what you're selling here. You're selling the upsides. Yes, obviously the product matters, and maybe your customer or maybe your investor wants to get some of that product at a sweet discount. But ultimately what you're doing is you're talking the language of money here, right? The amazing upside of your business.
About how long does it take for founders to typically raise? I know it's a really difficult question, but generally in this using this approach, what are your observations?
Yeah, the joke is that you should have started yesterday, or maybe last quarter, right, or a year ago. The thing is that we have a very weird relationship with money. I think in this country in particular. And maybe in the Midwest, specifically, but people tend to think of money as if it were a reservoir, and really it's more like a river. It's a perpetual flowing stream. That's what makes the business interesting for us. Now we're a little bit privileged in the fact that, look, we sit in a spot where we help people raise money. Well, there will never be an end for the need for people to raise money, right? Which is pretty awesome. But on the flip side, there's also never going to be an end for the need for people to deploy that capital profitably. Right? People need to seek, they need to seek returns, especially in a high inflation environment. So the good news is that, you can start, it's never too late to start, as it were, right? So, start early, start often. You have to realize that all fundraising, from selling cookies door to door to raising money for your startup, is the slow conversion of social capital into financial capital. And so if you don't have social capital, you're going to have a really hard time finding financial capital. That's why for us, it's important to ask, okay, well, have you asked your friends and family to invest? Now, people freak out. I've had posts on LinkedIn blow up and go viral, like, hundreds of thousands of views and hundreds of negative comments. I'm like, it's like, you guys are missing the point here. We don't expect our friends and family to invest. In fact, maybe some of them should not invest. Maybe I don't want my crazy cousin on my cap table, right? But here's the deal, right? We want to be grateful. Thank you for thinking of us. Now, is there someone who could invest? Right? And everybody knows somebody who could potentially invest. And that's a lost opportunity for most founders, is that, one, they don't ask friends and family, which is a huge red flag, by the way. This is a throwaway question that happens even when you get into the room with VCs and angel investors. They may look at the presentation, they'll applaud, they'll say it's disruptive. And then out of the corner, the last question is like, oh, hey, real quick, what did your friends and family think when you pitched it to them? And I've literally seen people like recoil in horror, like, oh, what if I fail? I'm like, okay, cool story. So you're a sociopath, right? You're not willing to ask your own mom to invest, but you want to ask my mom to invest? The answer is no, thank you, right? So again, it's not a trick question, right? But if you did well and your friends didn't have a chance to invest, they'd be mad at you, right? So again, ask your friends and family for feedback, right? Be grateful, and then ask for a referral. And that's really the lost opportunity. So when you raise money, it's going to come from three sources. One, from people who know, like, and trust you. Two, from people who don't know you, but they know someone who does know, like, and trust you. And by the way, they tend to be the most financially motivated. That's the toughest questions. And then three, from found or paid media attention. These are people who don't know you or know anybody who does know you, but they like your business model, right? So again, you must ask friends and family. They must know what you're doing, even if they don't understand it, right? Be grateful, but then ask for a referral. Super important.
Yeah, this is true. Even for customers and keeping revenue, that's the easiest way to find new revenue is referrals, and this applies to fundraising
Word of
as
mouth,
well.
right?
It's a golden rule. We've really appreciated you talking with us today, David. It's learning a lot here about how to get started, potentially working with Silicon Prairie. Where should people reach out to you? Where can we find? Tell us about all your channels.
Okay, so I'm LinkedIn, easy to find on LinkedIn. You can find us online. The web is sphi.io, Silicon Prairie Holdings Inc.io. easy to find there. My hacker alias is the Little Duke. I'm easy to find that way too. So it's a play on my last name, Duccini. Otherwise, like I said, LinkedIn is probably the easiest place to find me. I think there's one other David Duccini, but I think he's in France, and that's not me. So,
Yeah. Last question. Is this only for US based companies or is this a global thing?
it could be a global. We tend to focus on companies that have a U.S. based entity because they're the ones that are allowed to use most of the exemptions here. We certainly could do. It depends on where's the company based on. So we could do U.S. based companies, but only foreign investors. That's called Regulation S. We could facilitate offerings for other companies, but quite honestly, like we have so much business to focus on here in the U.S. and just can't keep our own house in order. We'd more than likely refer somebody to a different platform or broker dealer.
All right. Well, congratulations on your tremendous success, and
Thank you.
there's no shortage of people that need to figure out how to raise money. So it's good that you're a resource for people. Thank you
Absolutely.
very much for being with us. And anything else that you'd like to add to this, David?
I, just got to give a shout out to, the work that you're doing at Start Stack, right? In terms of the important role you play in the ecosphere, that a lot of times people that they come to us and they're just simply too early to raise because there's some structural things that, you all at Start Stack can help them with. So a lot of love, mutual admiration here.
Thank you very much. We do love business planning. We love product planning, and we love making sure that people are buttoned up with a plan. We like to tell people plan the work the plan. And we are customer number 2 of our own process. So we've been at this a while, and we are seeing clients have tremendous success, being really thoughtful about what they're doing and help them go further faster. So we appreciate the shout out.
Awesome. Thanks so much. Really appreciate
All right. Have a great day. Thank you.
Take care. Thanks.